Hi everybody. This video is for health insurance brokers, and in it we are discussing the individual coverage ICHRA. There's a lot to unpack about the ICHRA or the ICHRA, and I don't want to cover everything in this video, but what I wanted to talk about was something that I keep running into in discussions with people about the ICHRA, and that's that one of the things I keep hearing is that it's an attractive concept. People like the concept. And so you say, okay, well, what's the concept? And there's a number of points here, and I don't want to cover them all. I really want to focus in this video on the last one, and that's that one of the attractive points to an ICHRA is that employees have the ability to choose the coverage that best suits their needs. And by that, we mean they can get the insurance companies they want, purchase the networks that they want to belong to, and the plan designs that accommodate their needs. What I'm seeing as I look at the marketplace is that point, while it's good in concept, and I agree with the conceptual value to it, in the marketplace I'm not really seeing that as prevalently as the concept would suggest. And so I want to kind of make this point down here, and then I'm going to try and prove it empirically. And that is that employee choice is constrained by the product options that are available in the individual market. In order for the concept to become a viable strategy, we must have an individual market that offers plan options that are similar to or better than the options available in the group markets. And then we would evaluate those things on the basis of price, plan design, and network access. So in order to have a discussion about that, I have collected data for the state of Utah. That's where I'm located, and we're looking at 2021 data for the individual market and the small group market. And what I've done here, and I'm gonna show a few charts and graphs to kind of illustrate what's happening between the markets. But I've taken the data for each of those markets, and we're looking at Salt Lake County, and I've put them up on this scatter plot. And what we're looking at here is along the horizontal axis, we're looking at actuarial value, and along the vertical axis, we're looking at price. Each point on the plot represents a product. That's a health insurance plan available in each of the markets. Green dots represent the small group market. Orange dots represent the individual market. And what I see as I look at this chart is I see some significant distinctions between the markets. First off, the individual market across the board, or generally, seems to be higher. And when I say seems to be, there's a little bit to be debated here at the sub 65% actuarial value range. But above that, as you can see, there's very little overlap. So that's the first thing I would point out, is that you can see the individual plans rarely come below the trend line. That's what these lines, this orange line is the trend line, or the regression line. It's the middle point of the individual data. And then the same thing for the green line. It represents the middle point of the data for the group plans. The individual plans above 65 really don't come below their regression line much. In a few cases they do, but even when they do, they don't come down into a range where they're competitively priced against the small group options. So the distance between the 70% actuarial value point for the small group plan market, I should say, and the individual market is 22%. So for someone to buy a small group plan or an individual plan in the individual market, there is an average of 22% price difference between the small group and the individual market. I'm fumbling over my words, but that's what I'm trying to say there. There's a 32% price difference between the individual market and the small group market at the 80% actuarial value. Now, something that I hear a lot, or at least a sense that I get, is that a lot of brokers kind of feel that actuarial value is a kind of a silly metric, or they don't pay much attention to it, or they kind of scoff at it. And I'd encourage you to rethink that just a little bit. I wouldn't go into an employer and discuss actuarial value. I think it's maybe just a little bit too abstract for that kind of a conversation. But for our purposes, Actuarial value is a measure that accounts for all of the benefit parameters in a health plan. So it accounts for the deductible, the coinsurance, the out-of-pocket maximum, copays, etc., and tries to compress them down to a single value that helps us compare the plans. And the way they do that is by taking a claims database and projecting if we had a particular health insurance product that was configured with all of its various benefit parameters, the deductible, coinsurance, etc., what would the members' cost be under normal claim circumstances, and what would the plan's total out-of-pocket cost be? And so what a 70% actuarial value means is that the member would roughly be expected to pay 30% of the cost, and the plan would pay the other 70%. And that obviously, as we go up, it means that the plan would pay more, therefore the cost for the plans is more. But I like to compare plans along their actuarial value because deductible seems to be, to me at least, as I look at the data, a less and less reliable metric. Now, a lot of people I see recommending the ICHRA, they're usually not looking at data in this kind of way. They're usually looking at table data. So I'll give you an example. This is the actual underlying data for the individual market. And we're used to seeing this kind of data, but just maybe on an Excel spreadsheet. And the only other things we might have on here is the insurance company's name. I'm not putting that on here because I don't want to expose any information that the insurance carriers might not want us to. But and I really don't want to make a point about carriers in this video anyways. But we would be looking at this data and saying, okay, well, do we have similar plans in the individual market as what we have in the group markets? And when you look at data like this and you try and eyeball it, you say, okay, well, the plans are definitely different, but it seems to me that we have deductibles, and remember the deductibles are these two columns here, these two columns here. So this is individual, this is small group. You'd look at this and say, well, it looks like the plans are more or less the same, and that's because we're always looking at the deductible. In fact, when we look at this chart here, and we look at the deductible on this chart, we have kind of the same experience. If we're comparing deductibles only, what you see is that the difference between the plans becomes far less dramatic. Now, obviously, the plot is downward sloping. That's because the relationship, as deductible goes up, price goes down. As actuarial value goes up, price goes up. But we're looking at the same data. We're just looking at different benefit points. And so we're looking at the deductible over the price. And you'd say, okay, from this, it looks to me like the plans are closer together, or the markets are closer together. The individual market is more intermixed with the small group market. It does sit a little bit higher, you can see, but there's enough plan dispersion in both directions that you'd say, okay, I think that it's viable to send my employees or my employer's employees into the individual market. But if actuarial value is telling us a different story, then I think we need to ask why. And we can do that by saying, okay, well, we have a much clearer distinction here. What other benefit parameters might we want to look at? And so the first I want to take a look at is coinsurance. And for shorthand, I called it coins. I'm also going to pull the regression lines off because they make less sense in this scenario. But as you can see, as we look at this particular chart, the bulk of the coinsurances for the individual market are in the 40 to 50% price range. I mean, that's pretty significant, especially when we look at the group markets where the bulk of the coinsurances are below 30%. So that's what we're looking at coinsurance ranges as we go across the horizontal axis, and still price as we go up vertically. But we can look at this in this data in greater detail. There's a side-by-side, but maybe looking at a frequency chart. And so what this chart is telling us is, on the left-hand side, we've got the individual market. On the right-hand side, we've got the small group market. This is the coinsurance ranges here again at the bottom, and these are the number of plans that exist in each coinsurance range. And I've got a cheat sheet down here at the bottom, but here are the hard facts looking at the Utah data again. The number of plans in the individual market where the coinsurance is greater than 30% is 54% of the plans. And the hard number is that's 41 out of the total 76. So out of 76 plans, 41 of them have a coinsurance greater than 30%. That's this range right here. And as you look at that, what we kind of see here is what we see here as well, and that's that most of those plans are in the 40 to 50% coinsurance range. Now, in the small group market, 90% of the plans have a coinsurance less than 30%. And as you can see, the overwhelming majority of them have coinsurance in the 20% range, which is normal. You know, I've been doing benefits for as a broker myself for just under 20 years. And for most of my career, 80-20 coinsurance has really been the industry standard. Once in a while, you'll see plans that have a 70-30 as a way to kind of lower the cost. And we even see the other direction where they go 90-10. But looking at plans where the in-network benefit on coinsurance is 40% and 50%, that's really kind of a new thing, especially as kind of a common feature where that represents half of a market. That's a new thing. That's a lot for an employee to adjust to. And I'm not saying that it means that you can't do it or you shouldn't do it or we shouldn't consider those plans, but we have to bear in mind that if the idea of the ICHRA is that employees have the option to purchase the plans that they want, and most of the plans only have a coinsurance of 40 or 50%, that's going to be a jarring experience for them. And so you need to be aware of that. If we do the same thing looking at the out-of-pocket maximum, so same thing, we're looking at the individual deductibles right there, the single deductibles here, and then the out-of-pocket maximums, you can see that the small group market has a wider range of out-of-pocket maximums. In fact, in the individual market, we don't see an out-of-pocket maximum lower than $6,000 for the single. And then here's the frequency data. It's the same thing, just looking at it in a more quantified way. You can see that in the individual market, 78% of the plans have an out-of-pocket maximum greater than $8,000. So that's this right here. In the small group market, only 34% of them have an out-of-pocket maximum greater than $8,000 for the single. And it looks like 49% of them have between a $6,000 and an $8,000, and then 17% of them have a coinsurance less than $6,000. So the idea here is that you have actually more choice in the small group markets when looking at the plans that you can offer your employers. So it's significant to me that we pay attention to this, and you know, we're obviously looking at the state of Utah. Other states may have a different scenario, so I don't want to put in a final or an absolute word on this that says, you know, the individual market is not viable compared to the small group market. But what I hope I'm doing is giving you a little bit of insight as to maybe how better to look at the plans and compare them more holistically than just focusing on the deductible. Because if we just focus on the deductible, one of the concerns that I have is that as you go out and sell these products to your employer clients, the employees are going to go into that individual market and they're going to come back frustrated because they're going to find that they don't have the same product options that were available to them in the group market. If we look at deductible again, I'm gonna go like this. I want to show the deductible, single, and price, but let's now put on the vertical axis. Let's put the single out-of-pocket maximum, and this kind of expresses it. We're looking at the same thing, just expressing it in different ways. You can see we've got a range of deductible options here, and in the small group market, up to about a single deductible of $4,000, you've really got a range of choices in your out-of-pocket maximum, whereas you only have a very few isolated cases in the individual market where you have any kind of range of choice. And so that's obviously why the actuarial value is telling us a different story than what the deductible is telling us. So anyways, the point of this message is to just make sure that we're focusing on all of the details. I hope I've offered some insights into how you can compare plans a little bit better, and we'll catch you in the next video.